Recession. Are we in a recession? I don't know. And you know what? Nobody else does either. Yet. I see a lot of scary headlines out there. And certainly the worst case scenario could happen, but we don't know right now. So today I want to concentrate a little bit more on what is going on right now, just to kind of keep things into perspective. So when it comes to a recession, there are several metrics that economists look at. Now, some of them, it's too soon to tell whether they're heading into recession territory. Things like the wholesale retail market and manufacturing sector and the real income metric. It's too soon to tell right now. Now, another metric is GDP. And our GDP last quarter shrank from the quarter before. That is not a good sign. 2 quarters in a row of shrinking GDP usually signals a recession. However, another metric is the unemployment rate. Usually in a recession, unemployment ticks up. Our unemployment right now is at 3.6%, which is statistically everybody who wants a job has one. And even right now, there are 2 jobs available for every person looking. So I don't think our unemployment is going to be ticking up anytime soon. Well, that information is all well and good, but what does that mean for the real estate market? Well, I've already heard it being called the Great Housing Market Deceleration. Who are these people? Do they not have anything better to do? Now, part of the reason that deceleration is happening right now is because the Fed has been raising their interest rate to try to get inflation back under control. Now, that, of course, is bleeding over into the mortgage market, which has hit almost 6%, which seems crazy high. And it's gone up 2 points in the last year, which is crazy. But historically speaking, that's still pretty low. It certainly is doing its part to cool down what was an overly hot market. And if this recession environment does happen, it will probably serve to cool that market even faster. But I don't think it's going to be like the Great Recession of 2007 to 2009. Now, generally in a recession, the Feds will actually lower interest rates to try to get that economy moving faster. However, this time they can't do that because they want the economy to slow down to try to get that inflation under control. So those higher interest rates are here to stay for a while, and that will definitely cool the market a bit. But let's take a look at the inventory. Higher rates will lessen demand, but the demand still outweighs the supply. Millennials, which are the biggest demographic, are just getting into their prime home buying years. And I don't think we can really count on foreclosures to add any inventory in either. Now, we had moratoriums going on last year that are no longer in existence. So this year they are up a little bit from last year. However, they're still half of what they were pre-pandemic. And if you look at that 2007 to 2009 recession, they're about 10% of what they were back then. And back in that recession, home prices did fall by 20%. A little crazy. But house prices have gone up in 4 of the last 6 recessions. So are we in a recession? I don't know. The housing market is slowing down, and those higher interest rates are going to lessen demand. But there are still plenty of buyers to support what little inventory we have right now. Now, with the insanity of today's market, having a deep understanding of where we actually are is crucial. Watch these 2 videos that go into much deeper detail on both the current state of affairs in the real estate market and on the seller's market that we are still in. Thanks for watching. See you next time.